In a mere few centuries, humanity has traversed an astonishing journey. We have evolved from bartering sacks of grain in bustling medieval marketplaces to a reality where, with a few taps on a smartphone, anyone can purchase a Charlene they've never visited. This is the essence of the exchange, or more broadly, the market. To the uninitiated, it can appear as an overwhelming cascade of numbers, intricate charts, arcane terminology, and alarmist headlines. Yet, beneath this complex surface lies a profound mechanism that has fundamentally reshaped our world. It is largely thanks to these exchanges that we have witnessed the rise of railways, automobiles, factories, and the modern tech titans. For centuries, millions have pooled their resources, financing ambitious undertakings far beyond the reach of any single merchant. ENA, where greed and fear collide, where rigorous mathematical calculation meets gut intuition, and where fortune dances with risk. So, why did humanity conceive of such a peculiar and perilous instrument? And how did simple transactions involving grain in medieval Europe blossom into the interconnected global network that now governs the world's capital? Our story begins at the genesis of these exchanges, tracing their origins and understanding their gradual yet transformative impact on the world we inhabit today. Fasten your seatbelts. Let us journey back to Europe, perhaps to the 13th century, in a small northern European town. Picture narrow cobblestone streets, horse-drawn carts, and the cacophony of vibrant markets. Here, merchants from across continents converge, bringing wool, wine, silks from distant lands, and goods from the Arabian Peninsula. But a fundamental problem plagued these traders: the unpredictability of prices. After months of perilous travel along bandit-ridden roads or voyages across stormy seas, they faced a market where the value of their cargo could fluctuate wildly. A sack of grain might fetch one price today, only to be worth half that tomorrow. Or, conversely, a single rainy season could decimate a harvest, sending the price of remaining grain soaring threefold. The inherent uncertainty deterred significant investment. Yet, trade is the engine of progress. Without the willingness to embrace risk, there is no commerce. And without commerce, there is no economic development. It was the shrewdest merchants who began to circumvent this uncertainty. They started meeting in advance, agreeing upon future transactions. In essence, they crafted the earliest forms of contracts. In 6 months, I will deliver 100 sacks of wheat to you, and you will pay me a predetermined sum. This marked the birth of the futures contract, a revolutionary concept that allowed individuals to hedge against risk and secure prices. This newfound stability enabled them to confidently calculate potential profits and invest in further ventures, expanding their caravans, their fleets, their farms. Crucially, they needed a reliable venue, a central hub where these agreements could be formalized and where a universally recognized pred. Our focus now shifts to Bruges, in the 14th century, the vibrant heart of northern European trade. Here, on one of the city's squares, stood the house of the van der Bourse family, esteemed merchants and financiers. Their family crest, a significant detail, featured 3 purses, symbolizing their wealth and mercantile prowess. It was within these walls, amidst such commercial energy, that the concept of the exchange found its fertile ground. The van der Bourse residence became a nexus, drawing merchants from every corner of Europe, a place where the very foundations of modern finance were being laid, brick by historic brick. In the bustling heart of Bruges, a medieval town, a unique gathering place emerged. Not a castle nor a church, but a simple inn, the Ter Bourse. It was here, beneath its welcoming roof, that merchants, brokers, and money changers converged. They came not just for respite, but to exchange news, forge contracts, and trade vixels, the precursor to modern currency. This inn, initially a haven for travelers, gradually transformed. The area around it blossomed into a vibrant square, a hub for commerce and negotiation. The very word Bourse, meaning stock exchange, traces its lineage directly back to the van der Bourse family, the inn's proprietors. The torch of financial innovation was soon passed to Antwerp, a bustling port city in Belgium. By the 16th century, Antwerp had ascended to become Europe's most dynamic trading nexus. Ships laden with exotic spice acting continents. It was in Antwerp that the world's first purpose-built edifice for financial transactions was erected. With its high, arched roof to shield from the rain, and even designated areas for private discussions, it represented the genesis of the modern stock exchange hall. Remarkably, at this time, trading still revolved around tangible goods, grain, textiles, metals. Yet, alongside these physical commodities, a new form of exchange began to take root: financial instruments. In the Middle Ages, merchants navigating the fragmented landscape of principalities and cities, each with its own currency, faced considerable complexity. By the 16th and 17th centuries, this challenge had evolved into a lucrative business. Money changers and currency dealers became integral to the economy, facilitating what were essentially the world's first foreign exchange, or forex, operations, conducted not through digital interfaces, but through face-to-face interactions. The stage was being set for an even more profound shift: the trading of stocks, a mechanism that would allow individuals to profit or lose without ever physically handling a single gram of merchandise. To witness this pivotal development, we must journey to 17th century Holland, a land that would birth an innovation destined to reshape the global economy: the joint stock company. Amsterdam in the 17th century stood as the wealthiest city on earth. Its harbor teemed with hundreds of vessels, disgorging spices, tea, tobacco, and silver from every conceivable corner of the globe. Silver at this time was the primary medium of exchange, the bedrock of trade. Gold, while important, was largely reserved for national treasuries and colossal international dealings. Thus, silver functioned as the de facto global currency of the era. It was within this environment of immense wealth and burgeoning trade that a company emerged that would irrevocably alter the course of history: the Dutch East India Company, or VOC. This was the world's first publicly traded corporation. For the first time, any affluent citizen, not just royalty or nobility, could purchase a small stake in vast, far-reaching expeditions. The genius of this model lay in its accessibility. Investors didn't need to acquire a ship, nor did they need to hire a crew. They simply bought a piece of paper, a share, or stock, which granted them a claim on a portion of the profits generated from the lucrative spice trade. This democratized investment, allowing ordinary people to become stakeholders in colossal enterprises. This concept, in the modern era, is known as an initial public offering, or IPO. It is the process by which a company first offers its shares to the public. Through an IPO, investors can acquire a stake in the company, providing the business with vital capital for expansion, while offering investors the potential for dividends derived from profits, or the opportunity for speculative gains by selling their shares at a higher price. Thus, the very foundations of the modern stock market were laid, forever changing how wealth is created, invested, and circulated across the globe. The stock market, a term rooted in the concept of a fund, represents in economics a pool of capital invested in securities. At the heart of this system, the exchange, trading in these securities was not confined to immediate cash transactions. New forms of trade emerged, specifically forward contracts for buying and selling, which laid the groundwork for the speculative market we recognize today. Even in these nascent stages, the archetypes of bulls and bears appeared. These were speculators who acquired shares not for their dividend potential, but with the sole aim of profiting from price fluctuations, a rise or a fall. The very metaphor of the bull and the bear, incidentally, was born in England. The bull, striking upwards with its horns, symbolizes a bet on rising prices. The bear, pinning its prey downwards with its paws, signifies a wager on a price decline. Early brokers, in their pursuit of profit, engaged in outright market manipulation. They would spread fabricated rumors of sunken merchant ships, intentionally driving down stock prices, only to then acquire undervalued securities. The city thrummed with this volatile energy. Fortunes were amassed overnight, while others lost everything. For the first time in the history of commerce, a transaction ceased to be a simple exchange between buyer and seller for the general public. It transformed into an opportunity to profit from the ebb and flow of prices, from anticipation, and from an understanding of market sentiment. This inherent thrill, this intoxicating gamble, ultimately led to the first speculative mania in recorded history, a tale still recounted in investment and trading textbooks today. Let us transport ourselves to the Netherlands, just a few decades forward, to the era of Tulip Mania. In the 1630s, Holland stood as Europe's wealthiest nation. Ships laden with spices, gold, and carpets plied the trade routes, and its streets teemed with merchants and financiers. Into this vibrant commercial landscape, the tulip unexpectedly intruded. Yes, an ordinary flower, yet not entirely so. Certain rare varieties possessed such extraordinary beauty and uniqueness that they became potent symbols of prestige. This phenomenon became known as Tulip Mania. Merchants began to compete, vying to possess the most exquisite tulips. Then, the speculators arrived, and the frenzy escalated. People began purchasing futures contracts for bulbs, meaning they were buying flowers that had not yet even bloomed. They traded these contracts at prices that rivaled those of houses in Amsterdam. For a single rare variety, buyers would pay several thousand guilders. To put this into perspective, an average craftsman earned up to 300 guilders annually. Driven by the fear of missing out, individuals liquidated assets and took on debt. Newspapers, ever eager to capitalize on the prevailing excitement, published only reports of soaring prices, while neighbors boasted to each other about their latest bulb acquisition. But in February of 1637, at a routine auction, no bids were forthcoming. The price plummeted into an abyss, and within weeks, thousands of Dutch citizens were financially ruined. Thus concluded the first financial mania in history, the inaugural bubble that burst with a deafening crack. Since that time, exchanges and speculative bubbles have become inextricably linked. Yet, the lessons of Tulip Mania seem to have been largely forgotten. For very soon, in London, an even more audacious scheme would unfold, this time involving not flowers, but nascent maritime companies. We now turn our gaze to London in the 17th century. In the burgeoning coffee houses of London, a new social and economic phenomenon was taking root. While tea was beginning its ascent in fashion among the English gentry, it was the bitter allure of coffee that truly captivated the city's discerning gentlemen. These establishments, steeped in the aroma of roasted beans, became the vibrant crucibles where news, whispers, and vital financial decisions were forged. They evolved into the very heart of the nascent stock market, the arenas where fortunes were made and lost with the simple declaration of which shares to buy and which to sell. England, at this juncture, was in a fervent race to rival the overseas trading prowess of Fred. Each granted the exclusive right to trade in distant, exotic lands. Among these, one stood out with audacious promises: the South Sea Company, established in the year 1111. In essence, it was a grand, state-sanctioned speculation, a semi-governmental gambit. The company painted vivid pictures of immense wealth to be gleaned from trade in the vast territories of Latin America. However, a critical, albeit conveniently overlooked detail was that England held no dominion over these lands. They were firmly under the control of indigenous populations and other European colonial powers. Yet, such inconvenient truths were easily dismissed when share prices began their meteoric, almost irrational ascent. Lords, dukes, and even members of the royal family eagerly plunged their capital into South Sea Company stock, dreaming of doubling, even tripling their fortunes. In a breathtaking span of just a few months, the value of these shares multiplied tenfold. It is a curious footnote in this saga that even the renowned physicist Sir Isaac Newton held a substantial stake in the South Sea Company. He would later lament, with profound insight, that he could calculate the movements of celestial bodies, but not the sheer madness of human crowds. London was gripped by an unprecedented stock madness. Individuals liquidated their homes, incurred crippling debts, and pledged everything they owned in a desperate bid to participate in the frenzy. But, as is the immutable law of speculative bubbles, this one burst with sudden, devastating force. The illusion of boundless riches from South America shattered when the stark reality of the company's lack of actual assets and trade routes became undeniable. Share prices plummeted. Thousands of aristocrats and merchants found themselves utterly ruined. Hundreds of families faced bankruptcy, and the despair drove some to take their own lives. In the aftermath of this financial cataclysm, however, England did learn its lessons. Regulatory oversight of the stock exchanges was strengthened, paving the way for London to eventually emerge as the preeminent global financial capital of the 19th century. It was also in London, during this period of intense financial innovation, that one of the stock market's most controversial practices first took hold: short selling. Astute and, some would argue, unscrupulous gentlemen began selling shares they did not physically possess. They would borrow these shares from other owners, sell them on the open market at the current inflated price, and then hope to buy them back later at a significantly lower price to return the borrowed stock. The difference, they reasoned, would be their profit. This strategy struck many as morally dubious, profiting from the anticipated downfall of a company. Even then, contemporary newspapers decried short selling as a dirty game, detrimental to a healthy economy. Nevertheless, the stock market continued its relentless evolution. With each passing decade, increasingly sophisticated trading instruments emerged. Entire financial institutions materialized, and a host of new professions were born. Stockbrokers, financial analysts, fund managers, each playing a role in the complex machinery of modern finance. Our narrative now shifts across the Atlantic to the nascent heart of what would become the world's dominant financial system: America. We arrive in New York at the close of the 18th century, a young city, a former British colony, still carrying the scent of tar from its shipbuilding past, its unpaved streets choked with the dust of horse-drawn carts. It is the year 1792. Beneath the shade of a youthful buttonwood tree on Wall Street, a small gathering of brokers and merchants convenes. Here, they would affix their signatures to a document, a pact that would lay the foundation for a new era of American finance. It entered history as the Buttonwood Agreement, derived from the English word buttonwood, that is, a sycamore tree. This document, preserved through time, is part of the archival collection of the New York Stock Exchange. Essentially, they simply agreed not to cheat each other, to trade stocks amongst themselves, and to charge a standard commission of no less than 1.4%. No one at that time could have imagined that from this simple agreement under a tree, the planet's premier stock exchange would grow. Initially, trading took place directly on the streets. Brokers shouted prices, argued, gestured wildly, but within a few years, they secured their first dedicated space, and thus, the New York Stock Exchange was born. By the mid-19th century, New York had surpassed London in the volume of American railroad stock trading. And by the dawn of the 20th century, $100 million were already circulating here. In 1901, one of the most influential bankers of that era, J.P. Morgan, founded the world's first corporation with a market capitalization exceeding $1 billion. U.S. Steel became the largest industrial company of its time, a symbol of American industrial might. It was here that famous stock market indices were born, which reflected the sentiment of the entire market, not just individual stocks. They became as crucial an indicator as a patient's temperature. The exchange became a symbol of the American dream, a place where one could become a millionaire or lose everything in an instant. And this dream was destined, one day, to transform into a true catastrophe, plunging the entire world into depression. America, 1920s. It was the Jazz Age, a time of lavish parties, unprecedented technologies, and unparalleled economic boom. Electricity in every home, automobiles on the streets, movies featuring Charlie Chaplin. Millions of Americans actively traded on the exchange, buying shares in everything imaginable: railroads, chemical companies, tobacco factories. But the most dangerous aspect was that many people bought stocks with borrowed money, convinced of endless growth and having lost all caution. They paid only a fraction of the sum, borrowing the rest from brokers, expecting prices to rise. This is now known as leverage or margin. And then, October 1929. What began was what President Hoover would later call the orgy of speculation. Someone started selling shares, slowly at first, then more and more, and the panic set in. Within days, the stock market collapsed. Stocks lost half their value. It was the first domino to fall. People who, just yesterday, considered themselves wealthy lost everything in a matter of days. Banks began to fail, one after another, taking with them the savings of millions. American industry ground to a halt. 1 in 4 Americans found themselves without work. Families lost their homes and moved into tent cities. It was a lesson for the ages. It was then that the United States first understood that self-regulating markets are a remarkably fragile construct. The very fabric of financial exchange began to reweave itself. Strict regulations, born from the ashes of collapse, were enacted to govern the nascent stock markets. Companies were compelled to reveal their true financial standing, offering transparency to the public before seeking capital through the issuance of stocks or bonds. A series of predatory practices once rampant were outlawed. Insider trading, the clandestine dissemination of privileged information by corporate insiders to friends and associates before crucial reports were made public, was strictly prohibited. The manipulative pump-and-dump scheme, designed to artificially inflate stock prices before a swift and devastating sell-off, was dismantled. Margin requirements were established, setting limits on the leverage individuals could employ to purchase shares, thereby curbing excessive speculation. A pivotal separation was mandated between investment and commercial banking. This crucial division aimed to shield the deposits of ordinary citizens from the inherent risks associated with speculative trading, safeguarding the bedrock of personal savings. Most significantly, a new regulatory body emerged: the Securities and Exchange Commission, or SEC. This enduring institution was granted the authority to license brokers and exchanges, to police markets for manipulative activities, and to enforce rigorous reporting standards for publicly traded companies. The SEC's vigilance continues to this day, overseeing the entirety of the American financial landscape. As an illustration of its power, in the year 2018, the SEC levied a substantial fine of $40 million against the company Tesla. The penalty was a consequence of pronouncements made by its CEO, Elon Musk, which regulators deemed misleading to investors. Furthermore, he was temporarily removed from his position as chairman of the board. These comprehensive measures collectively rendered the market significantly more transparent and secure for the average investor, laying the groundwork for the modern, regulated stock exchange. Yet, history, in its relentless march, has demonstrated a persistent truth. The allure of easy profit, the siren song of rapid wealth, is a force that refuses to be extinguished. Time and again, humanity finds itself retracing its steps, succumbing to familiar temptations. For long. By the mid-20th century, a new era of expansion had dawned. American corporations were extending their global reach, and their stocks were increasingly perceived as a more reliable store of value than gold itself. The stock exchange transcended its original purpose as a mere conduit for purchasing ownership in physical enterprises. It evolved into a vast, intricate industry, employing millions. From financial analysts and traders to fund managers and risk assessors, a complex ecosystem of professionals emerged. The advent of hedge funds marked a significant shift. These entities moved beyond simple buy-and-hold strategies, embracing a diverse array of high-risk financial instruments. They constructed sophisticated mathematical models, meticulously engineered to extract maximum returns from market fluctuations. Then came the revolution of the computer. Trading floors, once characterized by their cacophony and frenetic energy, gradually yielded to the quiet hum of servers in climate-controlled rooms. The majority of transactions were no longer executed by brokers in starched collars, but by algorithms, executing buy and sell orders in mere milliseconds. Welcome to the era of high-frequency trading, a realm where billions of dollars change hands with a speed that defies human perception. The film Operation Paperclip, though fictional, captures this spirit, depicting young entrepreneurs racing to lay fiber optic cable across the country, seeking a fractional advantage in data transmission speed to gain an edge in the market. However, the 20th century also served as a stark reminder that even within this technologically advanced arena, ample space remained for irrational exuberance and the enduring frailties of human nature. The dot-com bubble of 2000 serves as a potent example. The stock prices of nascent internet companies skyrocketed, experiencing gains of thousands of %, driven solely by the possession of a web domain, only to plummet to zero shortly thereafter. And perhaps the most profound observation is this: even for those who have never personally invested a single dollar in the stock market, the ripples of its successes and failures inevitably touch every aspect of our lives. The ticker tape, once a symbol of distant financial machinations, is woven into the very fabric of your existence. Perhaps you envision it as a realm solely for sharp-suited bankers and frenzied traders, their eyes glued to flickering charts. But the reality is far more profound. These exchanges, these marketplaces of capital, touch the lives of every single person. They are the engines that power global enterprise. Major corporations ascend to these platforms not for sport, but to secure the vital funds necessary for expansion, for the construction of new factories, for the creation of jobs that sustain communities. The more accessible capital becomes through the issuance of shares, the more ambitious projects are launched, fueling economic growth and development. This, in turn, translates directly into opportunity, into employment, and into the wages that define our livelihoods. Even the rates on your mortgage, the terms of your personal loans, are indirectly tethered to the pulse of the financial markets. When the stock market falters, a palpable caution descends upon financial institutions. Lending becomes a more guarded affair, and the cost of borrowing can rise. To simplify, the stock market acts as a sophisticated barometer of the global economy. When investors, the keenest observers of enterprise, begin to retreat, it signals an underlying unease, a disturbance within business, technology, or the political landscape. It is the vast, interconnected nervous system of our economic world, exquisitely sensitive to every tremor, to the outbreak of war, to the outcome of elections, to the volatile price of oil, and yes, even to the enigmatic pronouncements of a single individual on social media. Consider the extraordinary evolution. From the boisterous, physical marketplaces of Bruges and Amsterdam, where merchants haggled over goods and futures, we have arrived at the palm of your hand. A few taps on a smartphone and you can acquire shares in technology giants, speculate on the volatile trajectory of digital currencies, or initiate a leveraged position on a currency pair, all from the comfort of your own home. Yet, amidst this technological revolution, a remarkable truth endures. Over these 5 centuries, while the mechanisms have transformed, human nature remains remarkably constant. Despite the era of high-speed algorithms and instantaneous information, it is often raw human emotion that dictates market movements, not pure, cold logic. We are, fundamentally, the same beings. Greedy when the market surges, driven by the fear of missing out. Fearful when it plummets, gripped by the instinct for self-preservation. We are susceptible to whispers and the seductive allure of quick riches, and we possess a disquieting capacity to forget the lessons of history. Statistics reveal a stark reality. Approximately 80 to 90% of individual traders in the long run see their investments dwindle. Thousands of books have been written about the intricacies of the stock market. Many have been read, countless hours spent absorbing the pronouncements of experts. But one fundamental truth resonates above the complex theories. The modern exchange, at its core, is still simply a market. And a market, in its purest form, is always right. The price of any asset is the equilibrium point where the desire to buy meets the desire to sell. When one person buys, another, at that precise moment, is selling. Remember this when the intoxicating euphoria of a new speculative bubble takes hold. And, if you are engaged in trading or investing, temper your triumphs. For every significant gain, there is a corresponding loss. The market is a zero-sum game, a perpetual dance of exchange where prosperity for one is invariably linked to the misfortune of another.